All right, let's talk Cigna. They just reported earnings, and while the numbers looked really good on the surface, the real story here is a huge strategic pivot that could really shake things up. So today, we're going to break it all down, what it means and where the stock might be headed. Let's get right into it.
So, first off, what did the market think? Well, it was a pretty clear thumbs up. The stock shot up over 4.5% the day they announced, and look at that, it traded on almost double the usual volume. So yeah, it's safe to say investors really liked what they heard.
And you can see why. Cigna posted a really solid beat across the board. Adjusted earnings per share came in at $8.08. That was a full 20 cents better than Wall Street was looking for. And on the revenue side, almost $72.5 billion, the consensus was way down at $69 billion. So a very clean beat, no question about it.
So yeah, those headline numbers are definitely impressive, but that's not the whole story. To really understand what's going on, we've got to look under the hood and see what actually drove that performance.
The quarter really boils down to two main things. First, the absolute powerhouse that is their health services platform, Evernorth, and second, some seriously sharp execution on the operations side.
I mean, just look at the power of Evernorth. The pharmacy benefit management part of that business, the PBM, saw its revenue jump a massive 20%. You have to understand, this isn't just a piece of Cigna's business anymore. At this point, it is the growth engine.
And this chart really shows you that focus on discipline I was talking about. They brought down their operating costs as a percentage of revenue by a full point. Now, that might not sound like a lot, but for a company this size, that is a huge deal. It means they're running a much tighter, more efficient ship, and that extra cash flows right down to the bottom line.
And on top of that great execution, management is putting its money where its mouth is. They bought back $3.6 billion worth of their own stock last year, and they just announced a nice dividend hike. You know, these are the classic moves of a leadership team that is extremely confident about the future of the business.
So, with such a great quarter, you'd think it's all smooth sailing from here, right? Well, here's where the plot thickens. Management is deliberately starting a multi-year reset of its most important business, and that changes the calculus a bit.
And this really gets to the key question investors had. With a beat this big and all those buybacks, why didn't the stock pop even higher? The answer? Well, it's all in the guidance they gave for the year ahead.
And here's the catch. Cigna's outlook for 2026 came in just a hair below what Wall Street was expecting. We're not talking about a massive miss here, but their earnings and revenue projections were both slightly lighter than the consensus, and that was just enough to take a little wind out of the sails.
But, and this is the important part, this wasn't a sign of weakness. That slightly soft guidance is happening because Cigna is making a huge strategic investment. They are proactively shifting their entire PBM business to a new, transparent, fee-based model. They're basically trying to get ahead of regulators and what their clients are demanding.
So, how is management talking about this big pivot? Well, on the earnings call, they were actually very direct about their game plan and their timeline.
The CEO, David Cordani, he really framed this whole thing around the customer. He kept saying it's all about access, cost, and transparency. So he's positioning Cigna not as a company that's being forced to change, but as one that's actually leading the industry to a better place.
And they gave everybody a very clear roadmap. They're starting with their own business on January 1st, 2027. Then, by the end of 2028, they expect at least half of all their Evernorth clients will be on the new model. You know, giving investors that kind of visibility is absolutely critical when you're making a big transition like this.
And the timing on this couldn't be better. Just before the earnings call, Cigna settled a big case with the FTC about insulin pricing. Management basically said that this new transparent model was a key reason they could get that deal done. What this does is it removes a major legal and regulatory risk for the stock. It just shows that Cigna is playing chess, not checkers. They're getting ahead of the curve.
Okay, so that's the whole story. You've got strong results, but it's mixed with this really bold strategic shift for the future. So let's put it all together and give you our take on what happens next. So for the next quarter, we're expecting another decent beat. But the metric everyone's going to be watching is the medical care ratio. That's basically how much they spend on claims. They guided to under 81%, and they've got to hit that number. As for the stock price, we think the big move is probably done for now. The stock is likely going to trade sideways for a bit, while the market waits for proof this transition is working. Which brings us to our final rating.
We are initiating coverage on Cigna with a market perform rating. Look, management did a fantastic job here. They delivered a great quarter and laid out a very clear and credible path forward. But now, it's a show-me story.
The market has already rewarded them for the plan. Now they have to go out and execute it.
So that's our take on Cigna. As always, remember to do your own research. This is not financial advice. Thanks for watching Talk Tickers.